Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague Christian Kerr. It is Monday, June 16th, 2025. And Christian, I hope you had a wonderful Father's Day weekend. I think you watched a little bit of golf. Hopefully, you had a nice time with family.
Yes, that is a nice part of the tradition of Father's Day that it falls on the final day of the U.S. Open. So I have a built-in excuse as to why I can't be bothered and can watch my golf. So it was very good Father's Day.
Wonderful. Well, you had the rest of the weekend to be with family, even if you weren't necessarily around the at the end of that golf tournament. So yeah, hopefully all the dads out there listening and watching had a good weekend as well. It is good to be with you. Here's our agenda for today. As we always do, we'll start with a market recap, and it was really interesting. Needless to say, with a lot going on, pushing in a lot of different directions. We'll go with around the world in seven charts. If we were more creative, we probably would have done around the world in eight charts as a playoff of the 80, but we're just going to do seven. You're welcome for not doing 80. That would take a little longer than 30 minutes. Agenda item three, inflation update. The Fed's in a tricky spot, we'll say. I'm interested, Christian, in your thoughts on what we might get from the Fed this week, in addition to any potential developments on the Middle East conflict, and got some key data as well, including retail sales that we will preview. So let's start with the recap. So, I mean, Christian, we got started off on a real nice positive note. We got the framework of an agreement with China, and we got a good CPI, had some nice gains heading into Friday, and then it all fell apart.
Yeah, I mean, geopolitics has a tendency to sneak up on you. I don't think, this has been in the news of late, but kind of the attention's been mostly on kind of the Russia-Ukraine situation. So, but I think it is quite interesting just here we are, day four of this, and markets shrugging it off for the most part, which I know we'll get into in a little bit. But, that's my biggest takeaway is, if you had told me this time last week that, we're going to see basically attempts to take out the nuclear production facilities of Iran, and markets are basically going to be unched after that. I would have I would have not believed it. So markets continue to surprise is my biggest takeaway.
Yeah, we will get into this more, but certainly the market is used to Israel and Iran firing missiles back and forth at each other, although not at this scale. So, this thing is fluid, needless to say. The latest headlines here, right before we jumped on, are that Iran's willing to talk. The market's rallying on that. But last week it was all about energy. Of course, oil prices spiked on Friday on the news of the initial Israeli airstrikes on Iran. Brent crude up over seven. We'll have a chart on that here in a little bit. So it was really that combined with defensives that ended up working last week. And you had a little bit of a flight to safety on the dollar after Friday, but not much. The dollar really, I mean, it was down last week, right? Or at least through today, as we've kind of unwound the safe haven trade from Friday on. The market's kind of optimistic bent during Monday's trading session. So, that's certainly something we're going to focus on in our charts, Christian. But we've also got the strong bond market last week. CPI part of that. Anything else going on in the bond market you want to highlight?
Yeah, for me, it was just I can't remember in my, I don't know, 25 years of doing this where you get a geopolitical event like we did on Friday and bonds sold off, right? Pretty, more towards the belly towards the long end, which was just quite surprising, which, I think is part of the bigger, push-pull dynamic that we're seeing between debt concerns and the way bonds are supposed to act. And that's kind of within a higher inflation world that kind of, maybe makes sense. But, that was probably the most interesting thing for me last week. The reaction we had on CPI, I think that was quite normal, but just, getting the event we did where stocks are selling off and you're also kind of getting, yields moving up was something that I don't remember seeing. So I thought that was quite interesting.
Yeah, the market is clearly looking through the uptick in oil prices and not factoring in sustained inflation that's showing up in the bond market. That is, of course, very positive. So here's your S&P 500 chart. We are over 6,000 now as we're recording this. We're a little bit below it when we priced this chart at Friday's close. This is likely to get to an all-time high fairly soon. I think today's action certainly increases the chances of that. We've got, market that's not really that overbought, and the breadth is pretty good. How do you think the technical setup looks, Christian?
Yeah, and we've been talking about it, just given all the levels that we've broken through, it seems a question of when, not if, we'll challenge all-time highs. I mean, I do think just given the time of year it is, i.e., we have quarter end coming up, so rebalances are pretty big. There's a propensity to try to front run those in the market. So I think you know, that's maybe a factor here. And then I think, you've got the big kind of buffered programs that sell large amounts of options, and they're kind of around these levels. So that tends to be a dampening factor on the market. So, I think we get there, but I'm just not sure how fast we get there because we have all these kind of their dynamics that tend to come into play into quarter end. So I think that might make things kind of a bit of a slog here in the near term. But then again, we come into early July, right? First half of July is kind of the most positive time of the year for the market from a seasonal perspective. So, I think once we get past quarter end, that's probably the idealized time for us to maybe make a run at it once we get past all this quarter end stuff. So that's kind of my uber near term thinking in terms of direction.
Yeah, that all makes sense. We have struggled a little bit, I guess, since the initial run at 6,144, which is the all-time high. Feels like momentum is starting to wane a little bit, so wouldn't be surprised if we get a little bit of a breather here before long. We've been talking a lot about how much optimism is priced in. That's more of a fundamental take than a technical take, but there is a lot of optimism priced in for sure. So let's now transition to charts, and I mean, these are really varied. We're going to cover a lot of ground here, as the around the world label implies. Uh, Starting with this is a list that we've compiled with some help from our friends at a number of different firms, CFRA, strategists, to see how stocks have historically responded to geopolitical shocks. And so this is actually quite reassuring for folks who may be nervous out there. If you look at all of these, this is 1 day return when the shock happens, then the total drawdown after the shock, and then how long it takes to recover or to bottom and recover. And finally, how long or how well the stocks do after the geopolitical shock. And you see here, I mean, there's a few key messages here. I mean, one is these drawdowns are pretty limited for the most part. Two, they end up playing out pretty quickly, right? So we're talking about typical 4 to 5% drawdown, maybe a few weeks, maybe a little longer than that. But typically these episodes don't last very long. And if you look at returns, 3, 6, and 12 months out, they're actually pretty normal, roughly in line with what markets do on average. So, the message to me here is that selling these geopolitical shocks typically is a bad idea. You're more likely to do well if you buy the dip or just ride it out. What do you think, Christian?
Yeah, to an extent. I mean, I do get a little nervous about just how complacent people have become towards geopolitics, because I do think every event's a little bit different. I think, if you were to narrow this down more to, all right, what are the geopolitical events that had lasting impact, i.e., like the Pearl Harbor attack. You could even go back further to when, Hitler invaded Poland, right? Like that had knock-on effects that this is going to be a different situation. I think that's the big distinguishing characteristic. So, I think this is definitely, a positive that most of the time these things tend to not be hugely significant events, but when they are, that's when you're going to have kind of a more lasting impact on the market. I think for this particular case, we've talked about this, with the Middle East, we've seen a lot of these before over the last few years. I think that's why we're kind of partly seeing the reaction we are now, but I think that's until we start seeing what's going on start to really impact the supply of oil. That's kind of the what everything hinges on. When you start seeing things that are gonna create less supply, that's when the markets will wake up. And so far, everything's yes, there's a lot of kind of tit for tat going back and forth. Yes, they've gone after some production facilities, things like that, but we're not really seeing kind of the major things that would have to happen to where the market's going to say, okay, there's a major potential supply shock here coming from this. And again, not to be callous to what's going on, but just viewing it from a pure market impact market, what's gonna move markets on this, and that's what they need to see for this to be more important. But listen, historically, whenever you get oil shocks that the markets, by its name, it's a shock, and you start seeing kind of oil going up fast and furious, that's gonna have a lot of pricing impact on things like equity. So I think, that $80 level in crude is really, really important. I think on the open we got to around 78 in WTI this morning, then kind of sold off pretty hard from there. As kind of the idea was, this isn't as bad as people namely, initially thought. So I think that's kind of a big level to think about near term. We start seeing oil go through 80. That starts having kind of those shock implications, and we just aren't there yet. But again, this is day four of this. So, I think we have to kind of be open-minded as to where this can go. But so far, I would say it's shaken out to not be as bad as you think it could have been, a week ago if you told me this was happening.
Yeah, certainly reports that Iran is willing to talk are helping reduce the chances of major oil disruptions. So that's certainly positive. And then, the economy is in pretty good shape here in the US. Is it slowing? Sure. Do we have an inflation problem? Sure. But we'll talk more about that in a bit. But economy is doing fine. And so $80 oil is not going to bring this economy to its knees. And if you look at some of these geopolitical shocks that did cause market disruptions, 1990 is one, 1973 another, 1981 another. These are really challenging economic periods. And so, yes, the higher oil prices were connected to the economic weakness, but the point is you had the economic weakness, and that's when the market does not do as well managing through these shocks. So pretty reassuring story here. We would say even if the market does decide it's more worried about this, we think that the drawdown will be contained. So we talked a little bit about oil there, Christian. I guess the market's not worried that we're going to have a closed Strait of Hormuz to worry about.
Yeah, I think there's, if we're going to see this thing kind of become more significant for the markets, I think there's basically a few things. Strait of Hormuz is the big one. I think that would really only happen if the Iranian regime kind of feels that they're about to get it becomes existential essentially, where they think they're about to get taken out, and then what do they have to lose type of thing. Because I think they are dependent on the revenues they get from places like China, so you're not necessarily want to
Yeah.
close that right now. So I think that's the big one, but that's kind of the option that probably only do when things are looking really dire. But I think other things like, say they attack, Qatar, Bahrain, Saudi Arabia, like some of the facilities there, attack a U.S. installation or personnel, that could kick things off. And then, of course, shut down the Strait of Hormuz. And I think on the Israeli side, so far they've avoided attacking Karg Island, which handles about 90% of Iranian oil exports. But I think we were to see that might be again, kind of from this lens of what affects supply. That would obviously be, a major potential influence on that. So I think those are kind of the four things that I'm thinking about in terms of what could change the dynamic right now. And so far we've avoided that stuff. So I think as long as we do, markets will probably for the most likely keep looking past this or erring more on the positive side.
Yeah, we're not military strategists, clearly, but part of the reason the market is up is it's essentially a peace dividend, right? It seems to me like the market is pricing in less geopolitical risk in not just the oil market today, because oil's down, but in the global equity markets as well. So anything can happen there. We're not going to make predictions on whether the regime stays or goes, but certainly the market is taking an optimistic um, tack on this. So let's switch gears to positioning, Christian. I know something you and I've talked about on this podcast and elsewhere. I've been surprised that institutions have been a little bit behind still.
Yeah, so I put together a few charts kind of with that being kind of the common characteristic. Just what are we getting? What are we learning from positioning? So yeah, this is a chart that shows the volume weighted average investors positioning in U.S. equities. So really reflects positioning in the market across all types of investors, including mutual funds, hedge funds, systematic, what I'd call rules-based investors, and then also retail, right? So self-directed investors. So kind of your full gambit of investor types here, and I think this explains a lot of the story that we've been seeing in the market, particularly in post early April and the all the chaos post the tariff announcement is that there was a major de-risking event, and you can see on this chart we got down. This shows you standard deviations, but we got basically the lowest levels across investor positioning that we've seen in since 2020 essentially. And as we've come back, uh, there's been this kind of belief or kind of lack of belief in this being a rally that you want to buy into, across investor types. I would say outside of retail, so more on the institutional side, there's just been thinking that, well, this is going to roll back over pretty soon. So I'm not going to fully engage and fully re-risk. And it's created this dynamic, whereas the market kind of continues to grind up, becomes very painful, because, if you're underweight your benchmarks and the market keeps going up, eventually a lot of investors and the institutional side are starting to get stopped in, feeling forced to come in at bad levels, and the kind of this grind continues. So I think that explains a lot of kind of what we've been seeing the last month, particular, is just kind of this lack of belief, but kind of forced to buy into this. And we're starting to get back closer levels around neutral. I think once you get to neutral, then that starts to be levels where, okay, we might finally be ready to see a more decent correction in the market. But that's kind of more than anything for me has been what's driving this market is just the how underpositioned investors have been on the institutional side, and kind of that pain trade has really been driving it. When you break down the particular styles or types of investor, hedge funds have really re-risked quite a bit, right? I would actually say that they're pretty much back to normal. It's really been kind of those rules-based types. They tend to be driven more by volatility, and volatility's come off quite a bit, and they have not really re-risked yet. So, as volatility, if it stays low, they're going to be forced to come back in. But a lot of that depends on kind of the look back period. So short-term volatility is now a lot lower, but you got to remember that a lot of what they're looking at can go back 3 months or more. So that's encompassing what happened in April. So as that starts to roll off, they might be forced to come back into this market. So it creates this kind of this bid potentially in the market, as those systematic types are kind of the real last cohort that is going to that needs to be forced to buy into this market. And we'll see if that happens. But that could be maybe that catalyst that we need to see us kind of go towards all-time highs here.
Yeah, so the other categories of investors are back to neutral already. So retail,
Oh,
hedge funds.
yeah. When you break it down, I mean, retail has they've been
Oh,
they
love
don't
retail.
have a benchmark, but they've been buying this whole way down and the move back up, right? So they've been very active, and I would say that they're above their normal position levels. Um, Mutual funds, I guess, the long only types, they're still a bit below as well, but they tend to be very slow moving. So in terms of a near term tactical catalyst, I'd say it's uh, will be more based on the systematics. But like I said, I think in the near term, a lot of it, it's kind of what I call the tail wags the dog. But you've got all these derivatives out there. There's a lot of leverage nowadays, a lot of option trading with zero DT and all this type of stuff. So I think that kind of creates an odd dynamic in the market right now where um, it's gonna kind of keep things hemmed in for a little bit, and then perhaps once we get past quarter end, then that some of these big positions start to roll off with the expiry, and then that could set us up for probably a move higher if things go the way you think they would around option expiration.
Mhm. Yep, quarter end almost here, and we've been in the buyback window, so you're getting some support from
Oh
core.
yeah.
So interesting stuff. So let's go to positioning. So I guess this chart looks at whether the buyers essentially that have been moving in have been buying more cyclicals or defensives, and looks like they've been going defensive.
Yeah, it goes back to that kind of point I was making where, a lot of this grind up has been there's this lack of disbelief, right? The most hated rally ever type of thinking. And I think this shows this very well, right? Where they've the investors have been forced to buy in, where they're saying, okay, I'm going to buy in, but I'm not going to buy the stuff that's a move. I'm going to buy, either I just trust this, I'm going to buy something more defensive, or if I'm forced to buy in, I'm going to buy, the things that aren't really moving. And I think that's what's causing a little bit more of this pain trade as well, is the fact that it has been so focused on kind of the areas or the pockets of the market that haven't been going up. So imagine you've been forced into the market, and on top of that, what you chose to get into is kind of underperforming. So it kind of perpetuates this dynamic that we're seeing. I think, so until you kind of get these to more normalized levels, I think it's going to be difficult for us to see kind of a meaningful sell-off, barring some sort of major headline or what have you, just because the way the positioning is right now, people don't have what they need to have on versus benchmark, and that's kind of perpetuating this kind of grind higher that we're seeing.
This is interesting because the cyclical sectors have been performing so much better, and the growth
Yep.
sectors for that matter, not just since April 8th, the market low, but also since, just a month ago, right?
Yep.
And that's the period where the defensive buying has ticked higher. So are those just going up? I mean, is it a volume situation? Like, how do you explain that these defensives are underperforming as positioning is ramping up in that area?
Yeah, well, I mean, this is on a Z-score basis, right? So it's not flows per se. So it's kind of
Right.
getting back towards, like how you are relative to benchmark. And I think those are a lot smaller. So, it doesn't necessarily translate into, okay, everyone's piled in this. We should see big
Yeah.
moves. So I think that partly explains it. But I think, my takeaway really is just the fact that it really highlights just how skeptical institutional investors are of this move. Doesn't mean they might not be right. Right. I mean, these things can take time to play out. And I can remember vividly in, like, the mid 2000s, right? There was skepticism in the being right. It took a while to play out. So, I would not be surprised to see, some sort of turn down. Let's say, we start seeing economic data start to, say from the tariff episode in April, it's a bit delayed. We start seeing kind of actual, real hard data effects of that, say later in the summer. You get in that typical kind of late summer window where you kind of get spooky things happen in the market. I could see them being right. So this isn't necessarily that they're wrong, but I think it explains a lot of just the skepticism that's been driving this grind up in the market, right? Like no one really wants to buy into this, and they're kind of being forced into it. And the fact that, when they are coming into it, they're focusing more on defensive because they think there is another leg down. Kind of explains a lot of what we're seeing right now in this market, where it's the pain trade essentially, and I think this chart highlights it well.
Yeah, more evidence that maybe this market's due to run out of steam a little bit here over the next couple percent, but we'll have to wait and see how stocks respond to a new high, which we think we'll get soon. All right, so let's turn to the Fed. I mean, this is a little bit of a preview of the week ahead because we have a Fed meeting this week, but this is your well, why don't you walk through why you put all the different terms on here and how people are supposed to interpret this, but LPL Research still sees one, maybe two Fed rate cuts this year.
Yeah, so the connecting theme of the charts I put together was really it's about positioning, right? And another, so this looks at open interest, and open interest really refers to the total number of outstanding futures and option contracts that are currently active that have not settled or closed. So different from volume because it shows kind of active engagement or active interest in particular instruments. And it can provide, insight into liquidity, activity levels, and just general interest in a particular contract. And I've found, over the years that kind of sudden changes in open interest can be an important leading indicator. And really last week, what I was trying to highlight from this is after the better than expected CPI data, we had some really big jumps in open interest in a lot of parts of the interest rate market, right? You look at the 5 and 10 years. This is the day before CPI and the day after. So big jump there. You had big jump in kind of in SOFR from now until end of the year. Fed funds for August, you had a big jump. So clearly not surprising, right? You had much softer inflation data, and we kind of have this interest, but we were leading into that event, right? The markets were getting very comfortable, perhaps a little bit complacent about, starting to see this idea, well, maybe we don't get any cuts this year, right? Like the Fed's going to be cautious for a lot longer, and we get that data, and all of a sudden, markets are being forced to price in the potential for, at least one, probably two cuts by the end of the year, right? That's kind of what we're seeing here. So, what does that mean going into this week with the FOMC? I think, I don't expect much from them, but I think the risk is that they might skew at least a little bit in terms of their commentary towards being a little more dovish, because they historically want to feed into market expectations. So markets starting to expect this. I think there's a good chance they might lean a little bit more dovish in their commentary. I don't think that necessarily means that we get anything uh, in July. But I think they start opening the door perhaps with kind of some of what they say this week. So I think that's kind of where the risk lies, just given from a fairly dramatic jump in open interest, which like I said, tends to be a fairly decent gauge of positioning and tells you kind of uh, where the market is leading near term.
Yeah, and for those who don't know, SOFR is just the new LIBOR. So, you know, short term, it's overnight, right, Christian? Really short term lending rate between banks.
And these contracts, those silver contracts, used to be the euro dollars. Um, Prior to about what a year and a half ago when they changed those. So that was the big euro dollar contract with one of the most liquid
Oh,
uh,
right. Mhm.
interest rate contracts in the world.
Very good. Yeah. So ramping up bets potentially here on short-term rates and the Fed. All right, good stuff. Let's go to the dollar here. Been getting a lot of attention because of how weak it's been.
Yeah.
The chart you're showing here is the yen speculation on, I guess, long yen. What's the takeaway here?
Yeah, well, so this chart, again, tying into that positioning theme, so this chart comes from the CFTC weekly commitment of traders report, which basically just provides a breakdown of net positions of different types of traders in the market on a weekly basis, so every Friday. And the two primary categories there are commercials and non-commercial. So commercials, think banks, corporates, people that have a commercial interest in the commodity future, what have you. And then you have non-commercials, which tend to be really just speculators, so people that are betting whether this thing is going up or down. So this is looking at those investor types, and you can see here, this goes back to what the late '90s. You know, Speculators are very interested in the yen going higher, right? So they are long yen, short dollars here. Now, to be fair, these charts kind of are a little bit distorted because as a contract gets more interest over time, so it's not really necessarily comparing apples to apples. So, now versus the mid 2000s, yes, we're quite a bit higher, but there's also a lot more interest. So that can skew it a little bit. But I think the point is there that there is um, we're at extremes here in terms of kind of bearishness on the dollar. And I picked the yen, but if you go look at a lot of other currencies, it's not too far off from here. There's a lot of bearish sentiment on the dollar, and I think Adam would agree, right? We're at a level in the dollar index. We were in this big 2-year range in the DXY. We broke below it then after we broke under it, classic breakdown, and then no follow through, rallied back towards kind of the bottom end of that range, failed there again, and now we're turning back lower. So this is kind of an interesting spot because you could say maybe it's a double bottom in the dollar index, or are we about to break down? So I'm a little nervous if you're a dollar bear that with sentiment so extreme and so already bearish, it's kind of, well, who's left to sell this thing? So we're kind of at an inflection point. I feel we've been saying that for a while, but we've been kind of letting the price action play out. But I do wonder if we can have the follow through necessary for dollar weakness with basically the whole market already kind of as bared up as you can be. So it's going to be something to watch here, I think, over the next couple of weeks, particularly in the quarter end. As the FX market does tend to get a lot of flow impact from quarter end too. So whether we can see kind of a definitive breakdown or not, I think Adam's looking for kind of a weekly to maybe 2 weekly close under kind of under these recent lows to really signal a more important breakdown. Obviously, that'll have implications for asset allocations. We've talked a lot about, international equities tend to do a lot better when you've got a very clear, defined downtrend in the dollar. Because you have money kind of rotating away, looking for places that's not the U.S. So I think it's going to have a lot of impact here. What happens over kind of the next few weeks in terms of how this plays out, whether we end up seeing a squeeze again, or whether we see kind of a further breakdown in the greenback here.
Yeah, the major events of the day are all influencing currencies, right? You're talking about Middle East, talking about trade negotiations all over the world, American exceptionalism, deglobalization, de-dollarization, all of rates fed, all this stuff. I mean, the dollar is really moving on all of this. It's kind of right in the middle of it. So
Well,
we
there's a reason why all the great macro traders, the Soros, the Tudor Jones, Druckenmillers, why they are primarily FX because it's in the vortex of it all, right? Like
Mhm.
if money's going to flow here or there, there's some theme. The FX is going to have some angle within that. And I think that's why it's such a big part of that world.
Yeah, absolutely. So your seventh chart is kind of along that theme, right? In terms of currencies. This is a pretty surprising headline, I bet, to a lot of folks. Gold has overtaken the euro to become the second largest holding of central bank reserves.
It was
What
surprising to
does
me.
this mean?
Yes, yes. So again, in that positioning theme, this is basically a chart of central bank positioning.
Right.
And last week, the ECB came out with some numbers saying that yeah, that gold has been doing so well over the last kind of 2 years that that's overtaken the euro as the second biggest holding for central banks. And a lot of that buying has been India, China, Turkey, even Poland. They've been buying a lot of gold lately. So I mean, a couple of things here. If we look at it from a positioning lens, gold is not cheap anymore, right? If you look at gold versus other commodities, it's very expensive, and that's kind of how a lot of gold traders look at stuff as ratios versus other commodities. I think we're, near multi-decade highs versus copper, things like that. So, it begs the question with gold now being, number two, we can start seeing central banks start to diversify into other things, right? We had a big, huge move in platinum last week. Silver's been on a run. We can start seeing central banks kind of move into those areas as well because, I'm just not sure they can continue at the pace that they're trying to get into gold. But at the same time, buying platinum or silver is not the same as buying gold either, right? So, maybe it just means that we see this continue, but I think it does start to beg the question whether we are going to see some, maybe some other metals join the party. But definitely interesting dynamic that I would not have expected to happen so soon. But also just shows in general, lack of alternatives central banks have right now, right? We've talked a lot about this, I think, of late, and we'll talk about it in the mid-year outlook, but the world changed really a lot after the Russian invasion of Ukraine, to where you just had a lot of central banks and a lot of parts of the world say, we can't afford to have, our assets confiscated. So what can we put our money into? that kind of falls outside the jurisdiction of the West, the United States, right? So that's, I think, been a big driver of gold over the last few years. And I think the other kind of thing I would point out is that we haven't really seen Western buying of gold, right? Like it's been predominantly in kind of an Eastern Hemisphere, let's say. So what happens when, if you start seeing kind of these deficit dynamics start to take hold more, what have you, and the West starts getting involved in gold or other kind of commodities similar to gold, what does that mean, right? Because there's a lot more money in the West. So, does that just spur this even more? But definitely a very interesting chart to me, and it signals kind of a lot what's going on, a lot of what can go on from where we are now, and it just highlights just how big of a move this has really been over the last call it 3 years in the gold market.
Yeah, this central bank buying is really sort of prolonged the reset of overbought conditions, I would say, in some of these gold, including silver, probably now platinum, right? So, I mean, that is just, it's such a big dollar amount or currency amount that it can really overwhelm these charts. And so, LPL Research has liked precious metals for quite some time. And frankly, as a hedge against what's going on in the Middle East and as a play on this dynamic, you'll have ups and downs, but probably higher at the end of the year than it is now. I think that's fair.
Yeah, tough to bet against at least.
Yeah, well, the momentum is strong and that begets momentum. So we'll keep watching that. But yeah, precious metals we think makes sense as a small piece of an asset allocation. So, all right, we went around the world in 7 charts. So let's preview the weekly market commentary, though many of you have probably already seen it as you're listening to this. LPL.com, research tab. It's an inflation update. This first chart, this is from Dr. Jeffrey Roach, shows the relationship between the ISM Services Price Index, which is a survey, and the CPI. So do you expect prices to go up or down? And how is that compared to actual inflation? And you see here a very tight relationship. That's not a big surprise. But what's interesting here is this little hook higher. This is tariff driven. Expectations for inflation have risen. If you look at a lot of other surveys, not just the ISM, but for example, the NFIB, the National Federation of Independent Business, or Federal Reserve surveys, you're going to see the same thing. So there is an expectation that inflation is going to tick up. It's largely tariff driven. Some other factors probably mixed in there, a little stimulus spending, but generally speaking, inflation probably ticking higher in the near term, which makes the Fed's job tough. This chart shows the relationship of PE ratios for the S&P to inflation as inflation drops, which of course it's not doing right now, but it's relatively contained. As inflation drops, PEs tend to rise. Valuations are off this chart. So we're at about a 22 PE now. Average is a little under 20 for inflation environments under 2%. So we've said it over and over again. We probably said it every week for the last several months. Stocks are pricing in a lot of optimism. They weren't on April 8th, but otherwise, pretty much all year, stocks have been pricing in a lot of optimism. Markets saying that inflation's come down. So inflation is really important for the Fed. It's really important for stock valuations. It's of course important for consumer spending, which really drives the economy. So in fact, I think the title of the weekly was, you can't overstate how important inflation is, something along those lines. It really is critically important. So, Christian, your comments on the inflation outlook and how important it is.
Yeah, I mean, listen. I think we've been seeing it, right? Inflation has just massive implications on asset allocation. Let's talk about the bond market, right? Over the last,
Mhm.
basically since the 2020s, bonds have not worked as well as they did prior to the 2020s as terms of a natural hedge in portfolios. And I think a lot of that's because we are in a higher inflation regime, right? Bonds,
Mhm.
basically their fixed income returns get eroded in a higher inflation regime, and that basically takes away that natural hedge aspect, and that's been the case throughout time. So I think it does have a lot of implications. I think in the near term, if we do see kind of a little bit of an uptick in inflation, that's going to make things tough for the Fed, right? They've been cautious, so they have a dual mandate, so it puts them in a very difficult spot in terms of I think they want to cut rates, but it's going to be just a lot harder to do that if you start seeing signs of upticking inflation, right? So it feels like something's got to give at some point, but I think, unless we see something kind of get a little bit more out of hand and to where they have to start signaling potential rate hikes, which I think is not on the table here, they're probably just going to be slower to cut rates, but I still think kind of, as long as this is well contained, we think it will be, they it just slows them down, but doesn't actually alter their course.
Yeah, it'll be interesting to hear from the Fed this week. I mean, that's again, other than following the events of the Middle East, I think the Fed's probably the going to get the most attention from market participants, although there are other things certainly on the calendar. It'll be interesting if they give you any clues as to how they're going to view inflation from the Middle East versus inflation from tariffs, and whether those things cause them to maybe lower their expectations for economic growth. Because if those things are negative growth drivers, they'll be more likely to cut sooner. If they view them as inflation problems and they wait for the inflation clouds to clear, then you could be late in the year before you see a cut. So I'm totally with you, Christian. They're in a really tight spot, and even though they're not going to cut rates this week, they do have updated dot plot, updated economic projections. It'll be very interesting to see what clues we get about how they might respond to inflation from these various sources. We also get some Senate text for the reconciliation bill this week. We're probably going to get a trade deal. The G7 meetings in Canada are going on right now. I guess odds-on favorite for a deal first might be Vietnam at this point, which is interesting. They're talking about maybe cutting that 40+% rate down to 20 or somewhere in the low 20s. There's talk about Europe maybe settling at 10. What do you think, Christian? What are we going to get on trade this week?
Yeah,
And
I
how
mean,
will the market potentially react?
to your point that there's a lot of optimism baked in. I think there's a lot of optimism that something gets announced in Canada, right? And if we don't see that, then that's potential negative. I'm not sure Vietnam matters too much. I think the market's gonna want to see something with Japan, Europe, one of the bigger trading partners. I think
Sure.
that's really what's important for the market. So seeing at least, you know, progress towards something that's actual real progress, not just saying is going to be really important because listen, they're sitting down together and it's starting to get to the point we're starting to get near important deadlines here next month to where I think the market's going to want to see kind of more bona fide evidence that something is going to happen in a positive light given all the optimism in the market. So I think that's going to be important. Not sure who it is, but as long as it's one of the bigger trading partners, I think is going to be important that we see something progress on in that over the next few days.
Yeah, and certainly last week's agreed upon framework with China is helpful. It's nowhere near a trade agreement in a broad sense, but it was at least progress, and the market's been able to take the worst case scenarios off the table with regard to tariffs. And frankly, that's been enough to really get back all we've lost and then some as a result of Liberation Day and the tariffs and all of that from April 2nd. So market's in a pretty good place, but a lot of optimism priced in right now for sure. So we'll keep watching the Middle East closely and certainly watching oil. But good news at this point that if the reports are accurate, that Iran's willing to talk and we might see a de-escalation. Certainly, we'd all, I think, love to see that. So thank you, Christian, for joining this week. Thanks everybody for listening to another LPL Market Signals. Really great conversation this week. We will see you next time. Everybody, take care and hope all the dads out there had a wonderful Father's Day weekend.